From my experience, times like these require people to own precious metals and precious metal securities. Now, I'm not saying that 100% of your net worth should be in these things. The lovely thing about precious metals is that lovely, I guess, when fear takes over in earnest, in other words, when normal people come to realize that their purchasing power is declining as rapidly as it is, precious metals prices tend to respond much more vigorously than most people believe they will. We've been conditioned to think about precious metals in the context of the last 20 years, as an example. But if you look at precious metals markets that I've lived through in my life, people say to me, well, Rick, the gold price is now 1,800 US dollars. I mean, up from 1,000. Can it go any higher? Have I missed the boat? My first bull market went from $35 to $850. What's that, 25-fold move, something like that? Yeah. My second one was much more constrained, a very tame bull market from 2000 to 2011, where it went from $256 or something like that to $1,900.
Yeah.
If we have a circumstance where the government isn't able to normalize interest rates and isn't able to control their spending and continues to debase the currency the way they have now, if they lose the faith and confidence of savers, like they did around the world in the early part of the decade of the 70s, that's an if. The gold price will surprise you. The silver price will surprise you, and it'll surprise you to the upside. The good news about that, Kerry, is that numerous studies have shown that a fairly small weighting in precious metals, 10 to 15%, can offset the damage that's done to 50 or 60% of your portfolio by the impact of increased interest rates on lower equities prices and lower bond prices. In other words, you don't have to have 100% of your portfolio in precious metals and precious metals related securities, 10 to 15%. And so when I say this is what you need to do, I can't tell you what your government's going to do. I can't tell you what my government's going to do other than something bad. But what I can think about is what I have to do. And what I have to do is insure myself against that collective stupidity called government. I'm looking forward to volatility. There's nothing in the world I like more than volatility, because despite the fact that my cash becomes worth less, I still maintain fairly high cash balances. I don't do that because I'm a masochist. I do it because having cash gives me the tools and the courage to take advantage of volatility rather than being taken advantage of by being taken advantage of. If you find a company that you think offers fair value at 10 Australian dollars, as an example, you've done the work on it, you've looked at the balance sheet, the income statement, all that kind of stuff. You like it, you buy some at $10 and it goes to $7. That's a good thing, not a bad thing. It means that something that you thought represented fair value at $10 can be bought at $7. So I'm equipping myself for volatility. In fact, I'm looking forward to volatility. I would urge all of your listeners to remember the great quote from Warren Buffett, where he said, you shouldn't buy a single share of a company if you aren't confident enough in its value that you wouldn't be delighted to see it fall 30 or 40% in price in the next 1 or 2 months so that you could buy more at a lower price. So I'm looking forward to volatility. Despite the fact that I see negative real yield on my cash savings, I maintain cash, although I believe gold and silver are good cash. I regard them as liquidity. I think that on a net present value basis, particularly the mid-tier producers in the gold and silver space offer the best relative value that I've seen in my career. The net present value of free cash flow, and this extends to the Australian producers too. The net present value of free cash flows from developed reserves and resources at current commodity prices is the cheapest that I've seen in 45 years in the business. The relation between free cash flows and net present value in the producing equities relative to the gold price is the best I've seen it. And further, the market share that gold and silver enjoys in precious metals equities is the lowest it's been for 40 years. Most people don't know this, but less than 0.5% of savings and investment assets in the United States, at least, are precious metals and precious metals related securities. In the last 30 or 40 years, the median has been between 1.5% and 2%. So it won't take an enormous flow into precious metals, merely a reversion to mean, to double or triple or quadruple demand for precious metals and precious metals related equities. I'll leave it to the imagination of your listeners what would happen to precious metals prices and precious metals equities prices if we saw a tripling in demand. I think that the real challenge for the precious metals business has been the S&P 500 and to a different degree the tech stocks. Investors have come to believe that competitive companies with pricing power are relatively good inflation hedges. And I agree with that, frankly. I think Buffett proved that in the 1970s. The difficulty is that most of us who pick those stocks aren't Buffett, and you need to pick them very, very well. With regards to cryptos, I think maybe crypto has been a challenge for penny stocks, for highly speculative stocks. But it's worth noting that globally, it's alleged that there are 650 trillion US dollars in total savings and investment assets worldwide. The market capitalization of precious metals is about 10 trillion. The total market capitalization of crypto is about 8 trillion, which is to say that precious metals and crypto combined are a pimple on an elephant's behind. They don't matter. They actually don't matter. What matters is this: institutional investors worldwide, the big endowments, the pension funds, the insurance companies, for 40 years have followed an investment mantra that said 60% of your assets should be in equities, 40% in debt. And these guys have an enormous problem because their bond holdings, that 40% of their portfolio, which is supposed to provide stability, guarantees them a loss. The biggest institutional investors worldwide have to figure out how to look after pensioners 20 years from now, how to fund universities 20 years from now, how to fund life insurance policies 20 years from now, where 40% of their portfolio absolutely, positively, without a doubt, guarantees a loss. Well, my supposition is that some of it has to go into precious metals. If you looked on the balance sheets and you looked at the asset statements of these same institutions in the 70s, the last time that we faced this circumstance, they were all long gold.